Why ARK? Why now? Well, we know long term, we think we're the best firm to protect you from the aftershock and make money during the aftershock. After all, I wrote the book. We know how to manage it, we know how to handle it. But why ARK? Why now? That's a bigger issue. So what I tell you is that our firm, we think, is the best firm actually to handle you before the aftershock. And that's because we know the global forces that are affecting the economy and the stock market. In particular, we know what's really driving the stock market, and that's the Fed. When the Fed is supportive of the stock market, it tends to go up. When the Fed's not supportive of the market, it tends to go down. And that's exactly the way it's played out. The Fed has stopped supporting the market with its money printing last October of 2014. And since then, well, market's been down. 2015 was a down year. The Fed raised rates in December of 2015, and guess what? January was a down market, quite a bit. So we're continuing that downward trend without support. And we think that's going to continue until the Fed reverses and ultimately tries to save the market. But we don't think they're going to do that until the market goes down another 20-25%. So we think that's an opportunity for us to make some money and, of course, be aware of protecting your primary capital. Another reason we're good shorter term, not just in the aftershock, is that we understand the global economics and the global macro forces driving the economy. In particular, China. The slowdown in China is getting increasingly severe, and very importantly, other people are seeing it. And this is affecting oil, other commodities, and also the industries, affecting oil industries, affecting mining, capital goods, and so forth. This represents a lot of opportunities to us to invest in. That, of course, is not what everybody else sees. A lot of other money managers would basically say, stay away from that. We don't want to short any of those industries or short any of that because that really doesn't fit in with their stock and bond sales model. They're basically there to help support stocks to go up. And if they go down, they'd rather just take the losses and hope that the Fed comes in and pumps the bubble back up and makes them whole again. We don't believe that. We're going to try to preserve your money in the downturn, even make some money in the downturn, but we're also going to be ready when the Fed supports to make money on the upside. Yeah?
Yeah, Bob, I think what we're seeing right now in January of 2016 and why ARK is a particularly appropriate investment for you now, if you're not already a member, to add more if you are, is truthfully the thesis is being confirmed. And as Bob indicated, when the training wheels are off, when the Fed's no longer supporting the markets by either printing money or keeping rates at zero, the market tends to teeter and fall. And as we've seen in the end of 2014, all of 2015, you've seen a clear trend down. And so in that regard, clearly this market's run out of tricks, the Fed's run out of tricks, and we're seeing a trend down, and we feel uniquely qualified to manage that. That's not to suggest that we won't see rallies in the interim. Even now, we'll see some dead cat bounces or some artificial rallies in an unsupported market. But overall, without that Fed support, we anticipate a relatively tradable direction, and we think we're qualified to manage that trade. Animal spirits can push the markets up. And of course, the Fed can always resort to quantitative easing or QE4 or Operation Twist 2, whatever they want to call it, to bring support or stimulus back into the market. We feel they'll be reluctant to do that in the near term, though, primarily because just in December of last year, only a month or so ago, the Fed announced that the economy is in such a strong recovery we can raise the rate by 25 basis points, the Fed funds rate. And so it'll be very hard for the Fed to reverse course after declaring a kind of layup victory by raising rates and then within a matter of months start printing money again. So they're really caught between the proverbial rock and a hard place. And without that QE, they're basically putting a rock on the markets, and it's going to be very hard for equities and bonds to rise without the support that they've gotten used to in the last 8 years with the Fed. So with that being said, I think we're uniquely suited, as Bob indicated. We literally he's written the book on it. We understand the bigger themes at play here. There are opportunities not just in a crisis or an aftershock to make money. We're certainly not a tail risk bear fund waiting for the end of the world. We don't even anticipate that, certainly now. But there are massive movements right now that can be exploited by those who anticipate them correctly.
Well, I think that's it. As Matt said, we're not a bear fund waiting for the world to end. We certainly will make money before the aftershock. As Matt says, we don't expect the world to end, but we do expect to protect you and make money during the aftershock. So I think now is a very good time to give us a call. Our number is 703-774-3520, and we look forward to speaking with you.